Hello, everyone, and welcome to Establish Healthy Credit. This is part of our annual Get Savvy, Grow Your Green Stuff webinar series. This webinar series is co-hosted by several partners across the state of Illinois, including University of Illinois Extension, University of Illinois Student Money Management Center, Southern Illinois University, Saluki Sense, Columbia College, Chicago, and North Park University. My name is Andrew Pellegrini, and I am the Assistant Director in University Student Financial Services and Cashier Operations, and I run the University of Illinois System's Student Money Management Center. So today I'm in Urbana, but sometimes I'm in Chicago, and sometimes I'm in Springfield. Jordy, would you like to introduce yourself?
Yes, my name is Jordy Justice. I am the Financial Literacy Coordinator at Southern Illinois University, Carbondale, and I manage our Saluki Sense Financial Wellness Program.
Thank you, Jordy. So like we said earlier, we are going to be using that chat a lot. So we want to put in the chat what state and or county you're logging in from today. Just let us know in the chat where you're logging in from today so we know what's going on. Since we have so much stuff to cover, I'm going to go ahead and hand it over to Jordy to talk about the other thing to do in the chat.
Okay, so I want you all to take a minute and type in the chat what comes to mind when someone says the word credit. What is the first thing that pops into your mind? Pay later, score, finances, credit cards. So lots of answers. I like to see that. We're going to go ahead and go to that next slide. Credit has many different definitions. When you look it up in the Merriam-Webster dictionary, we came up with several different definitions, and that's what I want you to take away from this, is there's no one word that defines credit. Credit can be defined as money that a bank or business is allowing to let you borrow to pay back on a future date. Think of a car for a car loan. It can be a record of how well you've paid your bills in the past. Think of a credit report. Think of that credit score. It can be an amount of money that isn't added to an account. Think of credit cards. So many different definitions, and we are going to hit on some of those today. Our agenda for today, we want you to be able to understand some terminology related to credit and what those pros and cons of using credit may be. We'll talk about some of the different types of credit and credit cards that are out there. And we want you to walk away being able to have some of those healthy habits so that you can build your credit responsibly.
So Jordy talked a little bit about the different definitions of credit, and it can be kind of confusing, and there's lots of different things to know. So let's talk about the different types of credit so you have a better understanding of how credit varies. So a lot of people are concerned with what their credit scores are. There's lots of different credit scores, and different types of credit impact your credit scores in different ways. So it's important to understand the main types of credit, which could be secured or unsecured, revolving or installment. And a single account could be a combination of these four main types. And there might be more types, but these are the four ones that are considered in most credit scoring algorithms. So let's say that, so like I said, there's different credit accounts or credit products, and they could be a combination of these different types of credit. We've listed a few examples here, this isn't an exhaustive list, and some accounts could be considered a different type of credit than what's listed here, but it kind of gives you a general idea of how many different combinations different credit products could be. So for instance, an auto loan could be a secured and installment, since the vehicle you're purchasing is often the collateral that the lender will take if you don't make payments as agreed, and you're often required to pay back that initial amount that you borrowed over a set period of time or months or whatever the case might be. Credit cards are interesting because they could be secured or unsecured depending on the type of card you're using, but they are a revolving type of credit either way, since you can charge more to them and then make a payment, or even pay off the entire balance every month or every set pay period. So that's important to think about. We're going to be putting links in the chat to more information on each of these different types of credit accounts. So you can check those out later, since we have so much more information to go over and there's lots to do. So we're going to spend a little bit more time today talking about different types of credit cards. So don't worry, we're going to cover credit cards in depth, since they are a little more confusing sometimes when looking at types of credit. So it's important to know that not all plastic credit cards or plastic cards are the same. So even if it has a Visa or a MasterCard logo on them, they could be either a debit card or a credit card. It's important to know the difference between the two. So before we start talking about credit and credit cards in more depth, let's make sure we're clear on the difference between debit cards and credit cards. So you probably have a debit card in your wallet. It's usually attached to your savings account or checking account, depending on the type of debit card you have. There's lower costs to get cash right now, so it's a good tool to have. Whereas if you have a credit card, you're going to have to pay the bill later, and it's higher cost to get access to cash. And there's a few other differences between the two, but I just wanted to cover those big features. I wanted you to answer in the chat, which do you think is safer to use, debit or credit? Do you think debit or credit is safer to use? And I can't see the chat because of the way my screen is right now. Jordy, what are some of the answers coming through?
We're getting kind of a combination of debit and credit.
Okay, yeah, this one's tougher than we think. So, credit is actually a safer tool to use. If your credit card is lost, you have protections under federal law. Your legal liability is limited to no more than $50. So that's really important to consider. However, if you don't report a lost or stolen check or debit card within 60 days, you're liable for up to $500, and your liability is unlimited after that 60-day period. So that's one reason why credit cards are safer to use. You also have more protections when you're online shopping. So let's say that you order a blender and you end up receiving a toaster. So legal protections that you have with a credit card say if you don't receive the product you ordered, or if the product isn't what was described, you can stop payment when you use a credit card, where you can't do that with a debit card so easily. And different financial institutions or the people providing debit cards and credit cards are going to have different regulations or different policies around these tools. But as far as federal law goes, credit cards are safer than debit cards. So that's an important consideration. We've talked a little bit about the law. Let's talk a little bit more about what the law does for protecting consumers. The Credit Card Act of 2009 provided a lot of benefits to consumers, so we're going to go over that a little bit. It's important to remember that while you need to shop around for the best credit card for you when you're looking at credit cards, it's much easier now to get a credit card with fair and clear billing and interest rate calculations than it used to be back before 2009. And this Credit Card Act also prohibits certain billing practices that weren't real great for consumers. They weren't real clear. So we're going to put in the chat some information about this Credit Card Act, but I'm also going to talk about some more things to consider with some of the law So credit card companies cannot raise your interest rates on existing balances except if your interest rate is variable and tied to an index and that index goes up, if you're more than 60 days late on a payment, if your card has an introductory period with a teaser rate, or you are in some type of workout agreement and you do not make payments as agreed. All right, so some other things that are important to consider with these protections is that those increased rates only apply to new charges. So they can't be like, oh, we increased your rate because you were late and you need to pay this increased amount of interest on the hot tub you bought 6 months ago. That's not how things are going to work. It's only for new charges. You also need to know that if you open a new credit card account, that interest rate cannot change for 12 months. And 6 months after an interest rate increase, there must be some type of review of your account with a possible reduction in that interest rate. So those are all very important things to consider. If you're under 21, it may be harder to get a card. Things have changed a little bit in the past, 9 years, 10 years. So the credit card companies have changed the way they do things. However, they are not allowed to recruit on campus. Before 2009, you might walk onto the quad and be able to see a bunch of people with tables out, giving out credit card applications for pizza. So people would ask, hey, you want a free t-shirt or you want a piece of pizza? Fill out this credit card application, and you might walk away filling out 5 different credit card applications and just have pizza to show for it. So those are things to remember. Also, you have to co-sign with a parent or be able to prove your capacity to repay if you're under 21. So that can make it a little more challenging to get a card if you're trying to establish credit. It's important to know that some lenders, some credit card companies are accepting scholarships and student loans as proof of capacity to repay. And you want to be very, very careful in those situations. So using those scholarships for anything but qualifying educational expenses could make your scholarships turn into taxable income. And you don't want to increase the amount of student loan debt that you're taking on just to end up with additional credit card debt. We are also going to put in the chat a link to a previously recorded webinar on student loan repayment that might be helpful for some of those people on that have student loans and want to look at repayment options. Some other things to consider with the law and what you don't have protections about is that the law does not limit how much your interest rate can rise if you are 60 days late. So that is very scary. Your minimum monthly payment can change based on a whole bunch of different criteria. So it's important not to assume you're going to have the exact same minimum monthly payment every single month. And you need to review your statements for new fees or charges so that you know what's going on with your account. All right, I'm going to hand it back over to Jordy to talk about pros and cons.
Okay, so let's look at some of the advantages and disadvantages to credit cards. First, let's start with the good. So Cindy decides to get a credit card. She uses that card to earn travel rewards, but she pays off her balance, the entire balance every month. So what are some of the benefits of looking at credit that way? If any of you would like to take some time to write that in the chat. Okay, I'm going to go ahead and look at some of them just for time's sake. But the upside of credit, and especially credit cards are one of the fastest ways to build your credit. You can buy something now and pay for it at a later date. As Andrea was talking about, you are protected against fraud up to typically $50. It can be used as a tool when you are faced with some type of an emergency. It is definitely more convenient for reservations. I know with most hotels you have to provide a credit card. And as long as you're using that responsibly, you are establishing a good credit history so that you can buy that house or whatever large purchase that you want to make later on. However, there can be some downsides. So that little piece of plastic can be extremely tempting. So Bob uses his card to buy pizza and beer for his friends. He only has a part-time job. He uses it too much, so then he carries a balance and he can't pay that entire balance each month. So that balance is revolving. So then Bob is paying a lot of interest. So the downside of credit are those fees and that interest. They can be really high and it ends up being costly, making it hard to pay off that balance. And it's very tempting when you have that piece of plastic in your hand to overspend as much as you may not think you're going to. It can happen, and it does damage your credit. There's always the possibility of someone compromising your account, and as we discussed, you do need to report that always. It's just important to understand the advantages and disadvantages so that you can work wisely with your credit when you decide to start building it. So let's take a minute, you guys. Fact or myth, put in the chat box. Carrying a balance is good for your credit score. Yes, lots of myths. Good job. It is a myth. Carrying a balance is not better for your credit score. That's something I hear from a lot of students, thinking that if they pay their balance off in full, that they won't build their credit as quickly. No, paying off your balance in full every month is ideal with a credit card. You're avoiding that interest. Okay, let's talk about shopping around for different credit cards. There's lots of different types of credit cards out there. We just want to take a few minutes to look at each of those and find which one is best for you based upon their features. Premium credit cards, not something you're typically going to start with. They're given to customers who demonstrate their creditworthiness and their ability to pay off debt easily. Like I said, that's probably something for later on, not where you want to start with. Secured credit cards. These are made for people who have maybe had some past problems, have lower credit scores, or maybe you're just working at building your credit. So what you do is you put down a security deposit, and that's your credit limit. And that's how you use that card to build credit. Great for people just starting out. There's also student cards, and that's another place I guide a lot of my students to. They have lower credit limits, a great way to start building that credit and developing healthy habits. So another thing to look into. There are standard cards that many of you are probably familiar with. They're offered to the general population. They carry that middle range interest rate and other fees at just that standard or average price. I like to guide you for the first time using a credit card more towards that secured or student card, but those standard cards are an option. Then we have those retail credit cards. So think this can be used at a store or a gas station where you have that card through. Generally, you get rewards points by using these cards when you shop or get gas at that particular store or gas station. There are business cards. So I know there are students that want to go in and start their own business. These cards are so that you can help create a business identity and keep that separate from your personal identity. So we're putting some information about business credit cards into the chat. Please feel free to look at that if that's something of interest to you. There's a lot that goes into getting a business credit card that we're not going to necessarily have time to cover here. So definitely take advantage of that chat source. So let's talk about shopping for the perfect card for you. When you start to shop for a credit card, there are several things to consider. If you plan to hardly ever carry a balance, then the interest rate or the APR may not be as important to you. But if you think you're going to have a revolving balance, that is very important. Look and see if there's an annual fee for those standard cards. A lot of them don't have annual fees. Those premium cards do. What's the late fee? What is the credit limit? Do your research and make sure you're finding a card that's going to best fit your personal situation. So we have a little example for you. We have 3 different card offers. I want you to take a minute and look at each of these card offers and tell me in the chat which one you would choose. We have this premium emerald, the standard green, and the secured lime. I'm going to give you a minute to kind of look them over before I start talking. And Andrea, feel free to chime in as we kind of evaluate these different offers.
So like we were talking about, there might be different credit limits. So this premium emerald card has that $20,000 credit limit. That standard green has $3,000, and the secured lime is going to be limited to whatever your initial deposit is. The APR differs pretty significantly between these three cards. The premium emerald is 8.5, the standard is 12.5, and the secured lime is 19.5. Those rewards might be something that's really important to you. So take a look at the differences between them. The emerald has that 6% cash back. There's points, 2 times points on travel for the standard green, and 1% cash back on gas. And then all the fees differ significantly. I'm not going to read all of them, but you can kind of check out that there's an annual fee for the premium. There's no annual fee for standard, but there's a $30 annual fee for secured lime. So Jordy, if you want to discuss whatever's happening in the chat.
Yes, I see. Let's see here. I see most people are kind of going towards that standard green. And I honestly think that or the secured lime would be a good place to start. They have lower credit limits. That's probably a good thing if you're just starting out. You don't want to start yourself with too much temptation. Learn to be healthy with your credit and then worry about those premium cards. Oh, we do have one that does prefer the premium, which is fine.
I think one thing that's important when you're looking at different types of cards and what the standard credit limit is you can request a lower credit limit. So maybe you want that cash back, but you're like, man, I don't want 20 grand in a credit limit. You can ask for 10 grand or 5 grand. So that's important. If you qualify for that one, that's an important consideration. Anything else, George?
I think we can move on. Let's talk about establishing some healthy credit as we're looking at these different options.
I love it. I love it. Okay, so we're going to do another credit fact or myth. Can you put in the chat if you think this is a fact or a myth? Credit card companies won't send you offers you cannot afford. And since I can't see the chat, can you let me know, Jordy, what they're saying?
Lots of myths. They've got that one figured out.
Okay, you are correct. That is a myth. However, I have heard a lot of people say that's a thing. I think that's changing in general with the general public. So companies send you, companies can do a soft pull of your credit report to send you pre-approvals, but sometimes the information that they are pulling isn't complete or accurate. So that's why you should definitely check your own reports for free once per year. And we'll talk a little bit more about where to do that later to see what lenders are seeing and watch for any funky activity that might be going on so you can address it. Let's talk about monitoring credit activity. Monitoring your credit is just like any kind of spending activity. It's super important part of managing your debt or managing your spending. So how do you prefer to monitor your credit? Put in the chat, do you prefer to do it on your phone, maybe in your credit card company's mobile app or some type of third-party app that aggregates your credit cards? Maybe on the website, or do you like to wait and get it in the mail and then review it? Or maybe you do some combination of all three. What do you do? Let me know in the chat. Also, Jordy, what are they saying in the chat since I can't see?
We're getting a combination of answers in the chat.
Oh, man.
Yeah,
okay.
It looks like all of these different sources are utilized.
Oh, man. Great.
And honestly, a lot more websites than mobile, which surprised me.
That is surprising. When I did a little poll with my friends, it was like 60% on mobile and 40% on website. So that's interesting. It's really interesting. Okay.
And good point. I'm going to interrupt. That was just brought up in the chat. Your mobile is safe to check your credit statement activity, as long as you're not giving away passwords, or you can even go far to do the touch identification. But your mobile is safe to check that.
Yes, and it's important if you're using your credit card company's mobile app that maybe you go directly to your credit card company's website to download it from the website, or verify wherever app store you're pulling it off of that it's from your credit card company. That's a lot safer than doing some third-party app too. So that's an important consideration, and definitely put a lock on your phone, be it a fingerprint lock or a pin lock. Definitely lock your phone. There's been some research done, and I can't pull it off the top of my head, but people distributed phones into large cities and then monitored the first things that people looked at. And they often looked for emergency contacts and then looked at bank information. So definitely want to lock your phones. Okay, so let's talk about monitoring account activity. You can review your account in lots of ways. We talked about that. Regardless of what way that you choose, if you notice that you didn't make a purchase that's showing up, contact your credit card company immediately and let them know. Even though you have protections with credit cards, it's important that you don't have more stuff to deal with later by addressing any potential issues as soon as you see them. It's really important if you do tend to solely look at mobile statements, is that you may not see any late payment warnings, minimum payment warnings, any notice of changes to interest rates or changes to account terms in the mobile app. So you might want to make it a regular occurrence that you check your physical statement that you might get in the mail, or to look on the website. So this is a mock-up of what the PDF bill might look like that you download off the website or that you get in the mail. The really important piece that I want you guys to pay attention to is where the late payment warning is and the minimum payment warning is. You have a bunch of other information, including what your balance is, what the minimum payment due is, and the due date. But that late payment warning tells you how much your late fee is going to be, which it will be different depending on what financial institution you're going through or your credit card company's policy, and your penalty interest rate may be different depending on who your lender is or who your credit card company is. That minimum payment warning also gives you some interesting information about how much time it will take you and how much more money it will take you if you only make the minimum payment. So in our example, if you only make the minimum payment, which is $90, it will take you 11 years to pay off that $3,000 balance, and you're going to end up paying $4,745. Whereas if you pay $13 more, that's it, $13 more. That's like one meal some places. It will only take you 3 years to pay off that entire $3,000 balance, and you will save about $1,000 over the course of that time frame. So it's important to consider what the minimum payment is going to do and what your issues are. I also want to point out that it's okay to make the minimum payment if you have to. I've had a few students that had so much anxiety about paying off their credit card balance as soon as possible that they didn't buy groceries. And we don't want to say that you should do that. You want to put your health first, and it's okay to pay the minimum balance once in a while. You just don't want to make it a recurring habit so that you can get out of debt and establish healthy habits now, right? Okay, so this is a section of your statement that might be at the end of all your account activity that shows interest charge calculations. This is at the bottom of a PDF statement. It might look a little bit different, but it will show what interest rate changes are showing up, and if you have different interest rates for different types of activity or whatever, that's going to show up here too. And you can look at what the interest rate is and how much of the balance that you currently have is subject to that interest rate and what the charge will be. And when the APR or interest rate went into effect. So that's an important place to look at interest rate changes. So let's say that you have lots of different types of debt. Let's say that you have, we're going to call this guy Steven. Steven has an electronic store credit card, and the payment is $76 a month. They also have a car loan for $359 a month, and they have a department store credit card, that one of those retail credit cards we talked about earlier, for $128 a month. But he can only afford about $350 a month after all his other living costs are covered. What can you suggest in the chat that Stephen does to deal with these three different types of debt that are a little bit more than what he can handle right now? So Jordy, what kinds of things what kind of ideas are we getting in the chat?
Nothing quite yet.
That's okay. This is a lot of information to think about, and we're throwing in some math here. So remember, Stephen only has $350 to work with. What, Jordy?
One suggestion was to get a second job.
Get a second job, increase income. It's a good way to deal with debt or other types of financial obligations, is diversify your income.
One comment was the car payment was too high. So yes, it's definitely important to look what you can afford in a vehicle too before you make that purchase.
Yeah, Stephen's already got his
reduce other expenses.
Redo other expenses. Okay. Lots of different things. Okay. So there's a few ways to deal with debt, and one of them is talking to your lender. So Stephen could ask for a lower interest rate, which could impact his monthly payments on some of those items, especially the credit cards. They might ask for a lower credit limit to reduce any temptations to exceed what their current obligations are. They might ask to change when the bill is due so they can better manage when to pay things and how that works with when they are getting their payment from work. If you choose to talk to a lender or talk to a debt collector, you need to make sure you can discuss your situation with them and talk about maybe setting up a payment plan. Regardless of what type of agreement that you put together or payment plan you put together or how good you feel about it, make sure everything is in writing. Seisha, who's on the chat today, also wrote a really good article on dealing with debt collectors that we're going to put in the chat. We'll also share that later today. So, or whenever I send out the recording, we'll make sure that that's included in the different resources that we share as well. But those are different ways to deal with debt where you're talking to your lender or the debt collector. And I'm going to hand it back over to Jordy.
Okay, so credit can be a great tool when used responsibly. So let's look at some of healthy habits you need to create when dealing with credit. First and foremost, only charge what you can afford. So overcharging is just going to lead to overspending, and then it gets hard to pay that back. So make sure you're only, at first when you get a credit card, pay your gas or pick one expense each month to pay and then pay it off when each bill comes in. That's a way to start developing those healthy habits. Always pay your bills on time. So your payment history is one of the #1 factors in determining your credit score. So make sure to pay those bills on time. Understand what your card terms and conditions are. So when you first get that credit card, a lot of them start with a 0% interest rate or APR. What does that jump to after that introductory? Things happen. Have any of you ever had car problems or something that's come up where you've had to have a large sum of money? Make sure you have some stashed away. Limit the number of cards you have. I promise you, even as responsible as you want to be, they can be tempting. So don't make yourself juggle too many things at once. Start with one card, get responsible with it. Recognize the signs of trouble. So it happens. You're human. Go get help. Come talk to us, the Money Management Center at U of I, the Saluki Sense office here. We're here to help you. So make sure not to exceed your credit limit. Don't use those cash advances. A lot of the times the fees are double what you're actually asking for with cash. Never lend your card out. I don't care if it's your best friend, your boyfriend, your girlfriend, never lend it out, because it's at the end, it's you and it's your personal reputation on the line, and you have to pay that money back. If you have to balance transfers, I'm kind of tricky on. If you're in trouble, maybe sometimes it might be beneficial, maybe, but for the most part, you want to try to avoid them because you're not getting yourself into charging too much on them. And make sure you're not getting into the habit of paying one credit card off with another. That's when there's maybe a sign of trouble that you need to reach out for help. So once you get credit and you start building that credit, you need to make sure that you are checking your credit report, okay? So free place, I know this was put in the chat earlier, to go check your credit report is annualcreditreport.com. There's 3 credit reporting agencies. You can check it for free annually through each of them. So essentially you get 3 free credit reports a year. Any questions in the chat on the credit reporting? Yes, annualcreditreport.com is a safe place to check your credit report. That's a great question.
It's, even though it's a .com, it's actually federally mandated. So the government said, hey, all 3 of you major bureaus need to have one single place where people can go to get their credit reports. So that's how that came together. Even though it's a .com, it was laid out by the government, making sure that you have access to the information that's being collected on your credit worthiness.
And Andrea, I know you have a recording of a webinar that you guys did specifically on credit reports and credit scores.
Yes, we do. There is a question about Credit Karma, apparently.
Yes.
So what's the question?
Would you recommend Credit Karma?
So Credit Karma is a third-party credit monitoring service. So just like any credit monitoring service that might be out there, you need to read the fine print and see how they are making money, see how your information is being shared. There's it's important to know where your data goes, because there's been a lot of data breaches. So make sure that you're analyzing that. From my understanding of the function of Credit Karma or any of the credit reporting apps out there or services out there, it might be a useful tool to look at how to monitor credit activity or monitor your credit worthiness, because I know they also share some credit scores, but there are literally hundreds of different scores, and we talk about that in the other webinar that we did. So we'll include that in our resources in the follow-up email. But it's important to know what the data is. That's why annualcreditreport.com is so important. So no matter what algorithm is being used by the lender or potential leasing office or whatever algorithm is being used, the data is accurate enough that you're going to have an accurate score pulled based on the algorithm, because there's literally hundreds of different scores for each person. So hopefully that kind of helps answer the question, I think.
Yes, that was a good answer.
Okay. All right. Are there any other questions on credit reports that we need to address?
Yeah, I think we should go ahead and go on, just so we can make sure we get to their questions as well.
All right. So I believe you have this one too, Jordy.
Okay. So I keep stressing the importance of having healthy credit because there's lots of benefits that come with that. Your credit score, it's used for a lot of different purposes. So it can reduce how much you have to pay for in insurance, think for a house or for a car, empower you. They can screen your credit for jobs, that is in some states. It can increase your ability to get the best rates on car loans, on home loans. There's so many benefits to having healthy credit, which is why we stress those things we want you to practice to increase that credit.
All right, so we've gone over a lot of information, a little bit quicker than I expected, but this program, this webinar is a borrowing badge eligible program. The University of Illinois runs a financial literacy badges program, and if you take this quiz that we'll put in the chat, you can take the first step towards earning the borrowing badge. All you have to do is complete 3 borrowing badge eligible activities to complete the badge, which you can put in LinkedIn or your online portfolio. It just gives you another method of showing your financial expertise or knowledge to maybe potential employers or whoever you want to show it to. Show it off to your friends, your mom, your dad, your grandpa, whatever. This is really helpful. Like Jordy just said, some employers are looking at financial stability as a measure of productivity in the workplace. So having that extra, like, I'm good with money can help you land a job. It may not be the deciding factor, but it might be something to help you in your future career path a little bit. We're also going to share our contact information for all of the different partners for Get Savvy in the chat. We'll also include that when we send up our follow-up email. So make sure to stay in contact with us. The Student Money Management Center and Extension are on Facebook and Twitter and Instagram. We also will post the recording for this event today in YouTube. So for the Student Money Management Center YouTube. And Jordy Saluki, are you on Twitter?
We are on Twitter, yes, under the SIU Financial Aid account. That's where we have our Saluki Sense communications.
Sweet. So thank you again. We're going to stay on and answer any questions that you guys might have in the chat, but don't feel obligated to stay on if you have other places to go, other things to do, maybe lunch to eat. So thank you, guys.
Yes, thank you so much. And as Andrea said, please feel free to put any questions you have in the chat, and we will definitely take time to address those questions.
All right, so I'm opening up the chat so I can see what's going on here. Looks like there's a few questions coming in. Kathy and Sasha, since you were monitoring the chat the entire time, were there any questions that we didn't quite address that we should address now?
We have a new one in that says how to know if the opt-out on smartphone is real or fake. We haven't answered that one yet.
Oh man, that's a good question. And it's, I don't know that I have the expertise to answer that. That seems more of a techie question. I can definitely guarantee if you opt out and they still send you stuff, that was fake. We might have to research that a little bit more.
There is an opt-out number now for smartphones that's real. Let me plug away for a minute and see if I can find it.
All right, thank you so much. Thank you very much, Kathy. And I know there's still a no-call list, but it's been a while since I looked at it. Has there been any changes to the no-call legislation? I know Kathy and Sasha stay a little bit up on that more than I do. Seisha made a good point that you can also block phone numbers you don't know. I've been getting a lot of calls, almost threats from an IRS imposter about not completing my tax returns for last year or something. I definitely did, so obviously it's a scam. But I've had to block the exact same call multiple times from several different numbers. Oh man, there's a lot of stuff coming in now.
Yeah, so it is the do not call registry is working for both cell phones and landlines, and I just put in the phone number for that you can call, or you can register online at donotcall.gov. And then you have to respond to a confirmation email. So that's the best we can do. That doesn't mean that people won't still call you, because not everybody follows the rules.
Also, scam artists aren't going to check the do not call registry.
Exactly.
Yeah.
But it can help.
It definitely can help.
My sense, I'm kind of looking over the comments here, and one thing when you're, I think there's some fear about what's happening over phones. What I tend to do if I get a call and I've answered it and I feel like maybe that's the right person I'm talking to, but maybe it's not, is I tell them, you know what, I'm going to hang up and call you back. And then I go and I look up their number from a different source. I don't call back on the same call that I just received. So if, for example, they say it's my bank, I'll hang up, I'll look up their phone number on either the web or probably the web. I don't really have a phone book anymore. And then I'll call them directly and say, I believe you just called me and were asking me about XYZ. Was that you? And to me, that's one way to deal with these calls where you're not sure who it is calling you, rather than just not answering them.
Absolutely, absolutely. I think the other thing is to be aware of what your financial institution's policies are. For instance, I have a credit union and they don't call you if there is seemingly fraudulent activity on your card. They freeze your card and then it forces you to call them.
Yeah, I mean, that is good if you can do that, but I have seen that policies have been changing with financial institutions and government agencies. So, it never hurts to just call them back, as long as you're choosing the phone number.
Absolutely, I agree.
Other questions, and I'll be quiet.
There's a lot of scams right now, both from and this isn't exactly related to credit card or credit health, but your compromised information could impact your credit worthiness. So it's important to address, I think, identity theft or how to avoid potential scams here. So we've talked a little bit about phone scams. There's also texting scams and email scams. There's all kinds of phishing scams that we have to be aware of. And scam artists are getting a lot better at replicating things. So even let's say that you get an email to your personal account or your let's say your education account, your University of Illinois account, for instance, and it says log in to your Moodle or Blackboard or your student account, they can capture your login information. It doesn't actually log in anywhere, and they can use the login information you provided to get into your student account and pull out information, or get into your Moodle and pull out information. So it's important to be aware before you start clicking on things, even if it looks super legit, to double check who the email's from, double check where the link is actually going before you click it. So if you hover over a link, you might be able to see where the link is supposed to go, especially if it's a hyperlink, like log into Moodle and the Moodle is hyperlinked. And then if you hover over Moodle and it shows a bit.ly link, don't click on it. So that's one thing to be aware of when looking into potential phishing scams. So someone asked, there was a recent breach in their family's insurance information, including children. Would this impact our credit worthiness? It could, because of any identifiable information that's shared, especially if their social security numbers, that could be compromised. And like Seisha said, definitely check your credit report, even for your children. If you are under the age of 17 and there's fraudulent activity on your credit report, it's a lot easier to get it taken care of before they turn 18. If they turn 18 in the midst of trying to get any fraudulent activity that they've recognized on their credit report taken care of, they have to file federal charges, felony charges against whoever committed the fraud. So I would, if I had children, I would definitely be checking their credit reports too, to monitor it and teaching them how to do it as soon as they were old enough. And Kathy has children, so you might have a different opinion. Kathy, what do you suggest? Kathy, you're muted if you're talking.
It's actually a fair amount of work to check your children's credit reports. There's a lot of data breaches out there. I'm not sure it's something you want to do every 3 months. So I kind of might disagree on this one a little bit.
Okay.
If there is identity theft on your children's accounts and they're under 18, they'll look at the date of that even if they try to correct that when they're over 18. So obviously your children can't take out credit until they're 18. So typically I don't believe that's too big of a deal. But if they're getting older, like they're getting to the point, it sort of depends on the age of your children. So if they're getting older and they're going to be applying for their own credit cards and things and they're approaching 18, then yes, that would be a good time to check your credit report. Whether we want to do that every year for our children, I have mixed feelings about that.
Well, Seisha has a small child. Seisha, what do you think?
I mean, I don't check Marcus's credit because he's less than 2. But if I knew that my family's information was breached, I would probably check it once, and I'd probably check it once a year. Like if I knew something was going on, I would check it.
So if you want to check it, I can put the information in that, but I believe you have to have all kinds of notarizations and things to do that. I'll find that for you.
Well, and I don't know what the current stats are, but a few years ago, there was a significant number of minors that had compromised identifiable information that showed up on their credit reports. It was usually an extended family member that stole their information. So that's a consideration too. If you have other people that care for your children that may be out of touch or may have access to information, monitoring credit can be helpful in mitigating any issues before they get old enough to notice it themselves. All right, so there's a question about repaying credit cards to improve scores. If you have several credit cards, what would be best advice to repay them? Snowball, we've talked about this before. Start with highest balances, lowest balances, highest APR. I have a different opinion, so I'm going to let anybody else that wants to go first address this.
I responded in the chat box already.
Oh, okay.
But I said that you can check powerpay.org, which is a Utah extension website that's free. And you just log in and you can put your credit cards and their balances and their APR and all of the above. And then you can actually just play with it to see which works better, highest balance, lowest balance, or highest APR. So
Yeah.
It's really user-friendly. It's been around for a long time. I would highly suggest it.
I agree with Seisha. The other thing that is sometimes helpful for people that aren't sure which to pay first is to pay off whatever keeps you most motivated. So for me, when I had several debts and I was trying to expedite paying them off, I paid off smaller balances when I got frustrated with stuff, and I was like, I already have this. I want to pay off this $300 balance and I just want to be done with it. And then I'd celebrate a little bit, even though ideally paying off the highest interest rate first was the best. Like from a cost perspective, I was looking at motivation and what most motivated me.
And Andrea, that is a fantastic point. And one of the nice things about PowerPay is that it lets you see with just a click of a button what's the difference if you do lowest balance or highest interest rates first.
Yeah.
And then you can say, oh, it's a $30 difference. I don't care. I'm going for the motivation. But if it's a $5,000 difference, that might give you a different kind of motivation.
Exactly.
So I like PayPal because you're given this information.
PowerPay.
PowerPay, sorry, thank you. I like PowerPay because it gives you the information for your situation and then you can make the decision that works best for you.
Someone asked if PayPal was safe, which is probably why you
Yes,
said
my
PayPal.
brain can only hold so many double P's in one moment.
And I agree with Seisha and Kathy's explanation that PayPal is probably as safe as any financial institution. I think in the past where PayPal has gotten a bad rap is when scam artists replicated PayPal information or requested information on behalf of PayPal and then stole stuff. So that's why it's so important to really investigate where you're getting messages from and where the links are going to before you click anything, or don't click anything. Go to the financial institution's website or log into PayPal by going to PayPal. Jordy, do you have anything else to add there?
No, I think you guys have covered it.
All right. So I think that if we don't have any other questions, we're going to shut it down. We'll wait for a couple minutes. But again, if you have places to go or people to see, go ahead and do that. And we will make sure that this recording is available and sent to you probably early next week.